Hey there, everybody. Welcome to another episode of Retirement Rescue Radio, where we explore innovative strategies and proven frameworks to help optimize retirements. In today's episode, we're going to dive deep into some of the powerful concepts of Vanguard's Advisors Alpha and Morningstar's Gamma frameworks. What the heck are those? Well, those are frameworks that they kind of quantify the potential value that advisors can bring to their clients. And it'll probably surprise you of where the most value comes from. It's going to go beyond traditional portfolio performance, and it's going to go from strategic asset allocation to even behavioral coaching. And so you'll learn how, according to studies, that advisors can potentially add up to 3% or more in net returns and significantly enhance client satisfaction. So we'll start off first with Vanguard's Advisors Alpha framework. And what it does is it kind of quantifies the potential value advisors can add by following wealth management best practices. So the framework helps retirement advisors articulate their value proposition in clear, measurable terms that go beyond just simple portfolio performance alone. And according to Vanguard's analysis, advisors can potentially add up to or even exceed 3% in net returns for clients through effective implementation of various strategies. Now, this value isn't an annual guarantee, but represents more irregular opportunities that may present themselves intermittently, often during periods of market volatility when clients are most likely to make most of those emotionally driven decisions. And so there are 7 different modules in Vanguard's Advisors Alpha. And the first one is going to be what's called suitable asset allocation using broadly diversified funds, or ETFs. So what is all that? Suitable asset allocation. Asset allocation based off of what your risk tolerance really is. And while it's difficult to quantify precisely, research confirms that asset allocation is the most important determinant of portfolio performance and risk characteristics. For retirement income planning, advisors should focus on creating strategic asset allocations that balance the growth potential with the need for stability to support the ongoing withdrawal. So that's the conundrum that retirees are facing is, I want my money to be safe because I need to use it for income, but I don't just want it sitting there earning point nothing. It's got to have some growth potential in it as well. And so balancing those two competing things are what's very, very important when it comes to asset allocation. The second one would be cost-effective implementation, or lowering the expense ratio, basically. And so what's an expense ratio? So if you have a mutual fund or an ETF that is basically inside of those is a basket of stocks. Now, mutual funds on the average tend to be a little bit more expensive than ETFs because mutual funds are trying to create a little bit of alpha, which means more return than what their underlying index benchmark is. What is an index benchmark? That is the index, the stock market index that particular fund is trying to mimic. For example, if you have an S&P 500 mutual fund, they're trying to actually kind of beat the S&P 500 by moving around the different stocks inside of there, more of an active trading strategy inside of a mutual fund. An ETF is trying to do that on more of a passive basis, and so hence the lower fees, but there is still a fee. And so the expense ratio, that's not an additional fee that goes to your advisor. That is a fee just for the investment itself. That goes to like the mutual fund managers, whatever company that is. That's where that fee goes. And so sometimes that fee can be pretty high. And so this one can actually approximately about 30 basis points annually by moving to lower cost funds. Vanguard's research actually examined the asset weighted expense ratios of mutual funds and ETFs and found that investors could save approximately 30 basis points. What's a basis point? It's a percentage of 1%. So if you say 100 basis points would be 1%. So 30 basis points would be 0.3%. So this basically saves an extra 0.3% annually by moving from average cost to low cost funds. And so this is actually, we do this a lot for our clients in ways that we've got certain portfolios that we use that are a basket of a bunch of stocks, but they're individual stocks. And so some of those portfolios, an individual stock has no expense ratio. So if you have a basket of individual stocks inside of a model portfolio, there is no expense ratio in that model. And so we have created some portfolios that do not have an expense ratio. Some do, some don't. And so it's just all a matter of what the client is needing. But that is one way of lowering what what clients are paying. And so there's additional value brought right there. And then number 3 would be rebalancing. So up to 14 basis points when risk adjusting a portfolio that is rebalanced annually versus a portfolio that just drifts. What does that mean? If you never rebalance, some of your positions could become outdated, or not outdated, excuse me. You could have an outsized weight to those different positions because maybe they've grown more than some of the others. So you might have more exposure to different areas. It'll represent a larger percentage of your portfolio that is exposed to those different areas. So we're just trying to rebalance so that we're adequately where we need to be. And so by implementing a disciplined rebalancing approach, advisors can help clients maintain their target risk profile and avoid the vulnerability that comes with that portfolio drift. Number 4, and this was actually this was the biggest area, behavioral coaching. This added anywhere from 0 to 200 basis points. And remember, 100 basis points is 1%. So this is up to 2% of additional return, potentially the largest contributor to improved outcomes right here, behavioral coaching. It involves helping clients maintain a disciplined approach to investing despite emotional impulses. And this service becomes particularly valuable during periods of market volatility when clients may be tempted to abandon their long-term investment strategies. I can give you an example here that happened recently. We've got, it was around April when Trump enacted his tariffs. He called April 2nd Liberation Day, if everybody remembers that. And the market kind of went nuts for a little while. And what happened was it corrected very, very quickly. And we did have several calls. Now, we tried to get out in front of it as well. We tried making some proactive videos, letting them know that we don't see any issues. This is probably a temporary blip. And it was. And so that's just the thing is keeping people's heads level during periods of extreme volatility and help keep them from making a decision that might actually not necessarily be the best decision for them. And so if you think about it, when something like that happened and it went down and then back up as quickly as it did, it would have been near impossible. You would have had to have pinpoint accuracy if you were trying to time the market during that time on when to get in and when to get out of certain things. And so that's one of the areas. I mean, timing the market has consistently been proven to be one of the worst ways to actually manage money. And so that is a huge service that advisors add to their clients. Because if you think about it, if you're a retiree, you don't want to worry about that stuff. This is not your world. You worked at whatever job that you had and you were awesome at that job and you have a skill set at that job. Your skill set might not be investing. And so from our perspective, there's a lot of things that we've seen that we know with the knowledge that we've had on studying this every single day, that we have a different perspective on this and we can help assuage. I don't even know the word for that. We can help lower let's say lower everybody's anxiety levels when stuff like that actually happens. And so because we've got that perspective. So there we go. Next one, number 5 would be asset location. Now, this will take a little bit of description on what this means. This adds up to 60 basis points of alpha, depending on the client's specific situation. And asset location refers to the strategic placement of assets across taxable and tax-advantaged accounts to minimize the tax impact. And this strategy recognizes that different investment types have different varying tax characteristics and can be positioned in differently tax type accounts to optimize after-tax returns. Now, that's a really fancy way of saying, okay, let me give you an example. So inside of a Roth IRA, you can have any type of investment inside of there. And when that money comes out, it is not going to be taxed at all. So you could have growth stocks, you could have dividend stocks, you could have bonds. It doesn't matter. None of that's going to be taxed when it comes out. Now, come back, remember that, and I'll come back around to that. Tax deferred accounts, IRA accounts, traditional IRA accounts. As long as the money is in there, you can move it around to any different investment, stocks, bonds, mutual funds, you name it, and there's still no tax. You don't pay any tax until that money comes out. So moving it around inside of there, there's still no tax consequence whatsoever. Now, keep that in mind, and we'll circle back around to that. The next type of account is, say, an individual or a joint account. That is a non-qualified after-tax account. You don't get a deduction when the money goes in, and if there's any movements inside of that account, if you buy or sell anything inside that account, that is going to create a taxable event, usually in the form of what's called a capital gain, meaning here's where you bought it, here's where it's sold. The difference is what you're going to have to pay tax on. If you bought it for $1,000 and it goes up to $2,000, you get $1,000 of capital gains that you're going to have to pay tax on. Now, in addition to that, any dividends that those stocks earn, you have to pay tax on those. Any interest that maybe the bonds inside of there, any that those earn, those will also have to have tax paid on them in the year that you earn them. And so here's where the asset location, could come in handy. Maybe you want some of your dividend and lower risk stocks and maybe even bonds in your IRA and your Roth, maybe, because you can have a little bit less risk inside of those. And those dividends, it doesn't matter how much dividends come in. If you're getting a 2% dividend, 3%, 4%, whatever, you're not being taxed on those. And so inside your non-qualified account, you might want to have more growth stock. So if there's any place for you to take any extra risk, it might be in that non-qualified account, because now you don't have to do as much buying and selling. You can just have it focused on growth and not as much focused on dividends. So those dividends aren't hitting your tax, your 1040 every single year. Now, also, since a Roth IRA is tax-free, and again, this all has to be molded within your overall risk profile, maybe you have some of your highest growth investments inside that Roth IRA as well, because guess what? Everything that comes out of there is completely tax-free. So you might want that sucker to grow as much as possible so you can have this huge tax-free amount that you can pull money from in retirement or pass on to your kids completely tax-free as well. So those are just some examples. That's not necessarily a recommendation at all. Those are just examples of asset location and how that can play a part in this. Number 6 of the 7. And remember, we're doing that Vanguard first, and then we're going to go down to the Gamma. So number 6 is withdrawal order. I can't even talk today. Withdrawal order for client spending from portfolios. And this adds an extra up to 1.2% or 120 basis points is how they put it, depending on the client specific situation. The sequence in which clients withdraw funds from different account types can significantly impact the longevity of their portfolio and the overall tax burden throughout retirement. And let me give you an example here. Maybe early on, you might want to take some withdrawals from your IRA, your tax deferred account, because maybe you're not old enough to have your required minimum distributions kick in yet at 73 or 75, depending on your age now. And so maybe you want to get rid of some of those assets first and save some of your tax-free assets for later. So what this does is it lowers your future required minimum distributions, is what this does. And so that could be one of the ways of working with a tax favored withdrawal strategy. Another one might be, hey, maybe you take income from your non-qualified account. Maybe you can do some Roth conversions with your tax deferred account. So there's all different types of examples here that can be done in order to decide where you want to withdraw from first. And then finally, number 7, total return versus income investing. And so significant, but not too unique to each investor to quantify precisely. We can add some significant value by helping clients adopt a total return approach rather than focusing solely on income generation, and particularly in low yield environments. So, all right, so those are the Vanguards, and the Vanguard Advisors Alpha Framework provides a structured way for advisors to assess their value proposition and prioritize activities to help deliver the greatest impact to you, our clients. And it also helps us communicate our value in concrete terms that clients can understand and appreciate as well. And because sometimes, whatever fee you're paying, you're like, what am I actually getting for that? So if you add up all of those, of course, 0 is the lowest amount of value that any advisor could add, right? Let's just be honest there. 0 would be the absolute lowest. But then if you add all of those high points up, like let's see, there was a 30 basis points for the cost-effective implementation, lowering expense ratios, up to 14 basis points for the rebalancing, up to 200 basis points or 2% for behavioral coaching, 60 basis points for asset location, up to 1.2% for withdrawal order. And that basically, if you add all those up, it comes up to 4.34% on the high end. So that's where they say that, over 3% that it could possibly add. So let's go anywhere from 0 to 4.34% that advisors can add in value just from all of those different areas. And most of the value tends to come when markets are going nuts, because there's some things that can happen when the markets go nuts that we can actually take advantage of and put you in a better situation than before, rather than panicking when the market does a little something wonky. We actually have some things we can do to take advantage of that. So now let's go to Morningstar's Gamma. So while Vanguard's Advisors Alpha primarily focuses on investment management and behavioral aspects, the Morningstar's Gamma framework, introduced by David Blanchett in 2013, expands the discussion by quantifying the value of more comprehensive financial planning decisions. And let's give you a definition of what the heck gamma means, because it's another $100 word, right? Gamma measures the additional value achieved by an individual investor from making more intelligent financial decisions. And this value is measured through a certainty equivalent utility adjusted retirement income metric. Fancy word for fancy math, right? That's what that is. So, all right, there are 5 components of this gamma framework. We got to take a step back here for a second, because I've said gamma, I don't know how many times, and every time I saw a little bit of background on me. I've been a huge superhero fan ever since I was a little kid. So, Superman or all the Marvel stuff when the Avengers and all that came out. Huge fan up until Endgame, Avengers Endgame. After that one, everything just kind of, went downhill. I believe the quality of the video or of the movies just kind of went downhill a little bit. But yeah, I can't think of gamma without thinking of Hulk. So the Incredible Hulk, all the gamma rays. So anyway, I had to get that out for a second. Apologize. But now back on point here. The 5 components of this gamma framework is number 1, total wealth framework for asset allocation. And asset allocation decisions should consider investors' total wealth, not just financial assets. That's what they're trying to say here. And that's going to include their human capital, which means any future earning potential. Obviously, that would be more important if they were a younger investor. Not so much with retirees, but there are still retirees that work into retirement or consult on some form or fashion in retirement as well. And so that includes the human capital or future earning potential, guaranteed income sources like Social Security, pensions, or even income annuities, and other assets. So it's looking at it from not just an asset allocation standpoint, but income and future, earning potential frameworks as well. Also, number 2 is it can look at dynamic withdrawal strategies. And a dynamic withdrawal strategy is going to determine the annual withdrawal amount based on the ongoing probability of portfolio survivability, updated mortality expectations, meaning when do you plan on dying? Or, obviously nobody knows that. But if you have some type of a life-threatening illness, all of a sudden that happens, well, now your mortality expectation has been cut quite a bit shorter. And then also current market conditions and what their overall current portfolio value is. And so basically based off of where you're at, how much time you might have left in retirement, what your portfolio value looks like, how much more you're going to have to spend, all of that stuff can go into a dynamic withdrawal strategy. Maybe on years where the market does really, really well, we're like, hey, you know what? You can afford to take a few more vacations now next year because you got more. If the market doesn't do well, so that year, maybe you kind of pull back a little bit and you don't do as much. So dynamic withdrawal strategies. Also takes into consideration any guaranteed income products like annuities. The Gamma framework does recognize the value of incorporating guaranteed income products like annuities to hedge longevity risk, which longevity risk is literally the risk of outliving your savings by living too long. So it does take into consideration that. Tax-efficient decisions. Similar to Advisors Alpha, the Gamma framework is going to highlight the value of tax-efficient investing and withdrawal strategies, including both asset location and the withdrawal sequencing. Where are we pulling it from, right? And so, I mean, to give you an example of tax efficient decisions, we have software that obviously, based on certain variables, can kind of figure out how much money in taxes, how much taxes someone could possibly potentially save by implementing a specific Roth conversion strategy. If they fill up the 12% bracket, or maybe they fill up the 22% bracket, or maybe they don't fill up the 22% bracket, but at least go to maybe that first IRMAA tier, that first Medicare tier in the conversions of those Roth IRAs. Maybe that's how it happens. And in that software, it can give us a range of what they could potentially save in taxes over their entire retirement. So let me give you a little bit of an example here, real quick. Let's say that the software shows that by implementing a certain Roth conversion strategy, we will save that person, let's just say $100,000 in taxes over their entire retirement versus doing nothing, basically. And if that's the case, let's also give an example. Let's say this person is taking out $20,000 per year from their portfolio to supplement any of the other guaranteed income streams they've got, whether that's Social Security or any pensions or any other annuities they've got. They're pulling out another $20,000 per year. Well, if we factor absolutely no growth whatsoever on those assets over that entire time, $20,000 a year in expenditures, and we just saved them $100,000 in taxes, that would extend their portfolio another 5 years. So we've extended their portfolio another 5 years without one extra percentage point of earnings, only with tax planning. And what I love about tax planning or implementing great tax efficient strategies is they're known. Like, and I understand tax laws can change, but once they change, we know what they are. We know what they are, and we know how to get around them, how to do whatever we need to do legally, right? Absolutely, completely legally, what we need to do in order to help somebody pay less tax than what they would have paid if they didn't do any planning. And so what that means is by putting in tax efficient strategies, your portfolio will last longer, even if you don't get any more earnings from the asset allocation. And that's why something like that can add alpha or add, extra percentage points of return, because now you've got an extra $100,000 in your pocket over your retirement that will cause your portfolio to last longer. And what's the number one fear of retirees still? Running out of money. Well, if a tax efficient strategy allows us to extend that portfolio another 5 years, will that give you increased confidence that your portfolio is going to last as long as you do? Absolutely. And so that's one of the reasons that we help with those tax efficient decisions. Next one, number 5 of the 5 gamma areas, liability relative optimization. What the heck does that mean, right? So traditional portfolio optimization is often just going to focus solely on maximizing some kind of a risk-adjusted return without considering the specific goals or liabilities the portfolio is intended to fund. Liability relative optimization incorporates funding risks like inflation or any future long-term care needs that might happen. It incorporates those into the portfolio construction process. So some of the what ifs that are out there. And if we want to try to quantify all of that, all those 5 areas of the gamma now, according to Morningstar's analysis, implementing those 5 gamma strategies could generate about 22.6% more certainty equivalent income compared to just a base scenario of assuming a 4% initial withdrawal rate and a 20% equity allocation. And so what that basically means is that's almost 25% more income than what you thought you could get is what this can be able to give you. So if you thought you were going to be able to only take out, say, $20,000 per year from your portfolio, maybe you can take out 25%, 24%, or 24,000, 25,000, somewhere around there. And so that's what this does. It gives you more income than what you thought you could actually have. And that's the same impact of an annual return increase of about 1.59%. And they term that the gamma equivalent alpha. So, and gamma can also potentially be achieved by any investor following intelligent financial planning strategies. And that makes gamma particularly valuable for advisors in helping their clients plan for retirement. So, all right, let's bring all this together here. So understanding those frameworks, the advisor's alpha and the gamma, is valuable, but the real impact is going to come from their actual implementation. Retirement income advisors can apply these concepts to develop comprehensive strategies that deliver measurable value to the clients. And one of the most powerful applications of these frameworks is the ability to articulate it in clear, quantifiable terms. And so, rather than just making vague claims about comprehensive service or personalized planning, we can now point to specific practices that deliver measurable results. And for an example, an advisor might communicate to his clients that by implementing tax efficient withdrawal strategies, we can potentially extend the portfolio's longevity by 3 to 5 years, like I mentioned earlier, without requiring any additional savings or any additional investment risk. Those are some things that we can literally say. So it can definitely help with that. And then also, let's think about the temporal nature of these value add opportunities. What does that mean? That means timing. Like, when do these value add things actually have the biggest impact? Many of them are not going to be equally available at all times. So it's not like you're going to have an equal weighting of all of those different things I talked about. 7 for the first one, 5 for the second one, the alpha and the gamma. Those aren't all happening at the same time. Some present themselves only during specific life transitions. Some present themselves during different market conditions. To give you a couple examples there, behavioral coaching delivers its greatest value during periods of great market volatility. The market's going up or down really, really fast, usually down really fast is when that's needed. Also, asset location strategies have the most impact during portfolio construction and rebalancing. So those aren't happening day to day, but whenever we're rebalancing and during the initial construction of it, that's going to be beneficial. Also, withdrawal sequencing becomes most valuable as clients approach and enter retirement, because you really don't have to worry about withdrawals if you're not retired. You're putting money in when you're not retired. And then also, tax loss harvesting is most effective during market downturns. So they're not all going to happen at the same time. And the ultimate application of this advisor alpha and this gamma concepts is the development of comprehensive retirement income strategies that address all of the dimensions of the client's lives, including investment management. So you create an appropriate asset allocation, all right, implementing it cost effectively and maintaining it through disciplined rebalancing. It's also going to include income planning, determining, optimal Social Security claiming strategies could be one of the things with the income planning, which pension option for someone to take, and whether or not annuities are appropriate. So now you've got investment management, income management, tax management, which will be developing strategies for asset location, withdrawal sequencing, ongoing tax loss harvesting, Roth conversions, all those kind of things as well. Risk management, addressing healthcare costs, long-term care needs, other retirement risks through appropriate insurance and portfolio design. And then finally, estate planning, ensuring efficient wealth transfer is aligned with the client's values and their legacy goals. So, those are basically the 5 main areas that most, if they're focused on retirement, those are the 5 areas that retirement advisors work in: investment management, income planning, tax management, risk management, and then estate planning. I usually call the risk management healthcare, because we're talking about long-term care needs and other stuff like that. But this goes into a number 6 as well, and that's the behavioral coaching, the one that was able to add up to like 200 basis points or 2 percentage points. And that's providing the guidance needed to maintain discipline throughout the changing market conditions. So 5 main areas of retirement, and then behavioral coaching, I think, is what is added in there to make sure that the other 5 areas are followed, right? So advisors can definitely, call themselves like longevity planning advisors, right? Because we're addressing the diverse needs of clients in retirement. And this model, both the alpha and the beta, extend beyond traditional financial planning to include experts in career management, maybe housing, aging in place, transportation, care management, transitions management. Well, I guess I can't call them experts. I guess got to call them professionals in those different areas, because experts is hard to substantiate. So we're going to call them professionals in that area. And so By implementing the strategies outlined in the Advisors Alpha and the Gamma frameworks, advisors can potentially deliver value that's equivalent to hundreds of basis points or many percentage points of additional return, and value that substantially exceeds the typical advisory fees. And more importantly, this value is achieved not through attempts to try to outguess the market, which is, like I mentioned, pretty much a losing proposition for most people, but through disciplined implementation of proven best practices and tax laws that we already know, right? And so that's it. Yes, we know what the tax laws are. We don't know what the market's going to do. So that's why I love tax strategies quite a bit, because once the laws are there, we know what to do with them. The market, I mean, the market could go up and down. Nothing that we do with the market can we say anything is guaranteed with at all, because the market can go up and down and everything there is kind of a best guess at that point. I mean, investing is all about predicting. Sometimes we're right, sometimes we're wrong, and hopefully, as investors, most of the time we end up being right because we have the perspectives. And so, yeah, those are all different areas that we definitely take into consideration here at Miller Retirement Group when we are making plans for people, because we want to be able to offer all of those different areas of increase in someone's plan, increase confidence, increase performance, increase tax efficiency. We want to do that for all of our clients. And so that is why we have all of those different areas that we work with whenever we work on someone's plan. So appreciate you guys joining us on this, hopefully a lightning journey through the realm of Vanguard's Advisors Alpha and Morningstar's Gamma. And if you understand this, by embracing these frameworks, we as financial advisors can enhance our value proposition to you guys and help all of our clients achieve better retirement outcomes. And whether it's through tax efficient strategies, dynamic withdrawal methods, our opportunity to add meaningful value is ginormous. I love that word. Maybe it's not a real word, but if I say the word and you understand what it means, it's a word. So stay tuned for more insight and more strategies in our upcoming episodes. And don't forget to like and subscribe and share with any fellow retirees that might be seeking to gain a little bit more clarity and confidence around their own retirement strategies too. So that is it. Take care. Have a great week.